Welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Tom Oviatt from WIMAC Capital, Inc. Tom is the Business Development Manager at WIMAC Capital, and WIMAC Capital is a mortgage brokerage company that works with financial professionals, including CPAs, enrolled agents, financial planners, and real estate agencies to originate loans with a variety of mortgage companies. Tom's been with WIMAC for 9 years. Previously, he worked as a manufacturer's representative to consumer sales companies like Home Depot. So Tom, thank you for being my guest today.
Pleasure to be here, Mike.
Today we're going to be talking about the current situation in the home mortgage marketplace. And by the way, this interview is taking place on March 8th, 2011. And because this mortgage marketplace has been changing actually fairly rapidly over the last few years, that's significant just to keep in mind related to the comments that we make, and you'll need to talk to whatever agent that you're working with about the current situation. Okay, Tom, let's get started.
Okay, good.
Okay, so first, why don't you give us a brief recap about what's happened in the mortgage marketplace during 2010.
Okay, I'll do my best. 2010, it was probably the most unique year in history for the mortgage market. Okay. I mean, just a lot of different things happened. Mm-hmm. Of course, everyone's familiar with the subprime bust and the real estate bubble bursting and things like that. But we had a lot of changes in the mortgage industry. It was very difficult to get a loan. And we say we worked about 5 times harder now and longer than we used to do in the past, and still earn the same amount of money. The guidelines are quite a bit tougher. The lenders have painted a much smaller box for which a person can qualify for a loan. So not everybody that wants a loan can get them, and not everybody that is well qualified can get a loan just because of it might be value issues, FICO issues, certain things. Sometimes we can't count all their income just because Fannie Mae and Freddie Mac don't accept that type of income. But that being said, 2010 was an exceptional year for business. It was one of the best years we've had. We did a lot of loans, got a lot of loans done for people. But it was just very difficult, and I'm sure frustrating for a lot of people that couldn't get loans that really wanted them.
All right. Now, actually, what happened too is that towards the end of the year, we had like extraordinarily low interest rates.
That's the other thing. That kind of caught everybody off guard. If you remember, going into last year, people thought, you know what, we're going to see some good rates maybe up through March. And then we think rates are going to start going up. And towards the end of the year in December, they're probably going to be quite high. They're going to be in the 5s, maybe approaching 6. So that's what we were telling people. And then, we saw a little dip around May, and then they leveled off. And then come the fall, boy, these were the best rates ever. And it kind of caught everybody by surprise. The lenders we work with, which are all the remaining big lenders, they were all understaffed and got way behind on loans just because of not only the new government regulations, just they didn't have the people, the underwriters, to underwrite the loans. So they got way behind. A lot of people were waiting 90, 120 days to get a loan, and it made it really challenging because we can usually only lock a loan for 60 days. So we had lenders that would work with us, and sometimes they'd let us extend those locks past that time, but I know a number of people that just couldn't get the rates just because lenders physically could not get the loans done. So even though we had great rates, not everybody got it. So
right, and now rates have gone back up.
Yeah, they've gone up a little bit. Yeah.
Okay. Well, how about 2011? What do things look like for this year?
It's tough to say. It's funny. Back in November, December, all the leading bank economists were saying, don't worry, rates have gone up a little bit, but they're going to come back down in January and February. Well, that really didn't happen. Now they're telling us rates are going to start going up, so they're changing their tune.
Good news, folks. Maybe the rates are coming down.
Exactly. So I don't think you put a lot of faith in the bank economists. Personally, what I think is that we're going to see some real volatility this year. I think we're going to see days where we have real good rates, and we've seen it already with this mini oil crisis that we're having. Rates have improved, and then news comes through that they're going to solve it, and they're going to pump more oil, and everything's going to be good, and then the rates will go back up. So I think we're going to see a lot of that this year. They'll be volatile. Rates will go up one day, and then they'll come down the next. And it's just, we can probably get people good rates. It's just we have to be real careful on the day that we lock, and then get the loans done as quick as possible.
So I think a helpful barometer, a little bit, and it's crazy, but anyways, is just looking at the stock market. And that's, if the stock market is doing horrible, then probably rates are going to come down.
Yeah, that's absolutely true.
Stock market's roaring, then oh well, we're going to probably have a higher rate.
And traditionally, they price mortgages off the 10-year bond.
Yeah.
So if you kind of watch that every day, and if the yield is going up on that, you can be pretty sure that rates are going to go up. And if the yield is going down on that 10-year bond, eventually the rates will go back down. It's just like gas prices. They go up real quick, but they go down slow because banks like making money. So that's kind of the barometer. And if a person watches that 10-year bond, that's a pretty good indicator. And that's also works with the stock market. And that's generally true if you have a good stock market. If the stock market's up, generally rates are going to be up too, like you said.
Now, there are some banks that seem to have backed away a little bit from offering mortgages, particularly through mortgage brokerage. I guess what we call that the wholesale market?
Yeah. Traditionally it's called the wholesale market. Last year we saw one of the biggest exit that arena. That was Bank of America. And first part of the year it was, we're committed to wholesale. We are going to be with you every step of the way. And then bang, they decided they're going to leave it. Now, their competitor gave us some reasons why that was, and it's true. They had to buy back billions of dollars of loans from Fannie Mae. Fannie Mae felt that they weren't underwritten correctly, so they took a big hit there, having to purchase those loans back. They are still active at retail, and still doing a good job there as far as I know. And they operate with correspondents. So in other words, a mortgage bank that has their own source of funds could originate a loan and then sell it to Bank of America on a correspondent relationship. So they're still doing that, and they're getting a large proportion of their loans from this correspondent group as well.
Okay. I'm not sure I quite understand that.
Yeah, it can be a little convoluted, but to give you an example, you could come to us and we would originate a loan for you. And we may use a local mortgage bank that's in Walnut Creek or Pleasanton or Petaluma. Okay. And they would fund the loan, and then they would sell it to Bank of America because they have what's called a correspondent relationship with them. So you could end up getting a loan with Bank of America, but you'd be going through us and then through another intermediary. So
the loan is not originated through Bank of America. It's sold to Bank of America, but it's through a corresponding bank. So a bank that has a relationship with Bank of America that they'll tend to buy their loans. Okay. Now, let's just get into some of the good stuff. How has the mortgage lending picture changed in recent years?
It's like night and day. I mean, really, it's a complete different industry. The joke was in the past anybody could walk into the bank if you had a pulse, they'd give you a loan for 100% of the value of your property. And of course, that's just completely opposite now. Right now, you have to have a good FICO score, good credit score. You have to have good income that's documentable. And like I mentioned earlier, many times Fannie Mae won't accept the income that an individual has. They're going to want to see a solid history of earnings. So if you've started a business and it's very profitable and you've been in business 18 months, they may not accept that income. So you could be out of luck. So it's making it really difficult for people to qualify for loans. It's a much smaller pool of potential borrowers now than there has been in the past. The FHA still does loans with a limited down payment. You can come in with as little as 3.5% of the purchase price and obtain a loan, but they still have very strict guidelines, and they have upped the amount of insurance premiums that they charge over recent years. So when you put that into your payment, it makes it more difficult to qualify. So the FHA, used to be for people, first-time home buyers. It still is, but now they want to see somebody that has a really good income and maybe not a lot of down payment. So it takes a lot of people out of the market that are going to buy homes.
Right. And now the guidelines as far as the terms and the other things, these are pretty much being dictated by these federal agencies, right?
Yeah, right now, the only game in town is Fannie Mae and Freddie Mac, and they're the ultimate purchasers of most of the loans being originated in the country right now. Of course, Bank of America will hold some, and Wells Fargo will hold some, and Chase and Citi. But every loan that they take, they want to make sure if they need to, they can sell it to Fannie Mae or Freddie Mac. So everything has to conform to their guidelines. And they just keep constricting their guidelines. They just recently, and of course you've been reading in the papers, they're not real profitable, nor they have been profitable for a while. Fannie and Freddie. And pretty much everybody in the government would like to get out of that business. It's just difficult to do. So in an effort to become more profitable, they've done a few things that add cost to the loan. So for example, if you have less than a 740 credit score, there's going to be an additional cost to obtaining a loan now, and this just went into effect in February. If you have a second mortgage or a equity line, it could cost you more now to obtain a loan. So we have people that we could refinance in December. Now we can't get them the rate because of these additional costs that Fannie and Freddie have put onto the loan. So I don't say it's sneaky, but it caught a lot of people by surprise, and it took a lot more people out of the market. They can't get the rate they want. So Fannie and Freddie think that this will, and it'll add profitability to the loans that they're doing. So I guess from their standpoint, they're thinking it's a way to try to become solvent, but it's not good for the borrower.
So it's going to just make it a lot tougher. And when people are trying to sell properties anyway, it's just it's a tough time.
It doesn't help the real estate market to recover when it's more difficult to obtain a loan, or you can't see. And in this example, it could kick your interest rate up a quarter a point or 3/8 of a point, and then you wouldn't be able to qualify for the loan. So now either prices have to fall further, or you have to come up with more down payment to get that loan. So it makes it difficult.
So right now, there's really not much of a secondary market at all for these loans.
There really isn't.
That means that banks, for example, although you talk about the corresponding bank, but other than that, there's not a lot of buying that's going on.
There really isn't. No. That's the unfortunate thing, and everybody from the president on down has said we want to get the government out from under Fannie Mae and Freddie Mac because it's just a big drain. Private bankers that have looked at it have said for somebody to step in and play that role, they're going to have to take a minimum of 2 percentage points. So if the interest rates right now are 5 with a Fannie Mae loan, it's going to be 7.
Oh boy.
So that's not very appealing either to the borrowing public.
Right.
But you can see it. People are not going to jump in and take that risk unless there's some reward. So it's going to be difficult for the government to extricate themselves from Fannie Mae and Freddie Mac and still have us recover.
Right.
So I don't see them doing much, even though they say they want to, until the economy starts humming along again.